non-recourse deductions or makes distributions, right? So it could be a distribution too of the proceeds of a non-recourse liability eligible to an increase in partnership minimum gain. The partnership agreement must contain a minimum gain chargeback, saying, hey, you get these deductions, at some point, guess what? You're going to pay a price, a tax price, right? You're not going to have to pony up the negative capital account, but you're going to have to bear the potential tax consequences associated. Make sense? Sure. We don't want to leave Uncle Sam in the cold. He's our uncle to all of us, right? And our clients. Item 4 on the next page. All other material allocations and capital account adjustments under the partnership agreement must comply with the basic 704B regulations, okay? Not surprising. So, just to make sure we get our feet wet here, what I'd like to do is just spend 5 more minutes and then talk about next class. But talk about the first problem on page 146, because let's set that up so that everyone can hit the ground running this weekend to make sure we understand the nature of the problem, okay? So let's look at it together. And then I'll start class by reviewing this, but this way, try your luck, try your skill on this problem by hearing me out. You have 2 partners who are going to form a limited partnership, and G, the general, is going to contribute $80,000. The limited partner is going to contribute $320,000. Not surprising, right? The moneyed partner is the limited partner. And they're not going to have unlimited liability. They're a limited partner. Everyone agree? They don't want to go negative, right? Partnership purchases commercial real estate paying $400,000 cash and borrowing $1.6 million. Okay? And notice it's a recourse or non-recourse. Everyone sees it's non-recourse, right? From a commercial lender. Okay, so it's at risk. Everyone agree? Don't have to worry about section 465 here. We have to worry about 469, but for the moment, let's not. That's an issue for a different day. The terms of the loan require that the payment of interest only. So just keep in mind that the mortgage amount is going to stay as a balloon mortgage. The mortgage dollar amount is going to stay the same for all 5 years. The partnership agreement allocates all income, gain, loss, and deductions 20% to G and 80% to L until the first time that the partnership has recognized items of income gain that exceed the items of loss and deduction over its life. And then all further partnership items are to be allocated equally. So it's a flip, okay? We've seen this before, that they're going to allocate all the deductions until they start making money, then the money is going to be split 50-50 ultimately. All the items, at the time the partnership agreement is entered into, there's a reasonable likelihood that over the partnership life, it will recognize amounts of income and gain significantly in excess of losses and deductions. Partnership agreement requires that all allocations are to be reflected in appropriate adjustments to the partner's capital accounts, and liquidation proceeds are to be distributed in accordance with positive capital accounts. Okay? However, only G is required to restore a capital account deficit. L is not. Okay? No deficit restoration. And it contains a qualified income offset. And that's good news, right? We have a qualified income offset. Well, and there's a minimum gain chargeback, right? So it looks like, if you look at the safe harbor test, things are looking promising. Agreed? Finally, the agreement provides that all non-liquidating distributions will be made 20% to G and 80% to L, until a total of $400,000 has been distributed. Thereafter, this thing becomes profitable, everything's going to go 50-50. The partnership depreciates its property using a straight line method, and we're going to assume a 10-year recovery period. And we know, guys, we have property worth how much? $2 million, agreed? And since it's a long Wednesday, We know what the depreciation deductions, I'll help you out here, $200,000 a year, right? We're going to keep it simple, right? So every year, it's going to be $200,000 depreciation deductions. And question A, where it said that the rental income from the property is 150, and we have offsetting expenses of 150, right? So the author, and just like they have the examples in the regulations, we're just going to look at who gets the $200,000 of depreciation deductions, right? And for starters, just let me help you. What are their capital accounts equal to at this point, at the start of the day? For G and for L. Say again? 80,000 and 320, right? Everyone agree? The starting point here is 80,000 and 320. Why? Because we start with whatever their contribution is, and we know them are we going to adjust it for the liability? No. Absolutely, categorically not. Right?
Because it's not recourse.
It could be recourse or non-recourse. Liabilities do not impact capital account. Amen, right? Not because it's not recourse. I repeat, liabilities do not change capital accounts. The liabilities change recourse or non-recourse or outside basis. Absolutely they do. Amen, right? Everyone got that? That's a critical point. You cannot fall short of the mark on that. And the question will be, in problems A through F, what can we do with respect to this $200,000 deduction that's going to happen annually, right? Who's going to get it and why? And your answer is going to be very different than perhaps what you saw here, right? Okay, so you guys have to spend the time, and we're going to start class with that. And then I will say this, the reading that follows here, targeted allocations, very important, okay? That's the trend. There are so-called targeted allocations. And then we're going to take a journey into Chapter 5, partnership allocations, income there's going to be what's called income shifting safeguards. Now, this too is very challenging. Okay, guys, be forewarned. There is a lot of material here. The good news for your team is we will not have a lot of reading. Theoretically, the reading starts on Chapter 5 at page 153. Everyone see that? We will go until page 172. If you guys can handle the arithmetic, that is less than 20 new pages or so. All right? But there is a lot of material here, a lot of challenging material. So I need, how many hours? 20 hours. All right? So I will see everyone next Wednesday, but brace yourself. We are going to have a lot of material.